Okay, it's a little bit after 1 o'clock. Welcome to Austin and to our April board meeting of the Texas Emergency Service Retirement Systems. Ron, will you be kind enough to do roll call for us, please?
Okay, Frank Torres.
Here.
Gracie Flores.
Here.
Dan Key. Here. Ron Larson, I'm here. Jenny Moore, not here.
She's out. She'll be late.
Taylor Allen. Here. Dennis Rice. Here. Don Shipman. Here. Steve Williams. Here.
Okay, let the record show we do have a quorum, and can I have a motion to excuse Jenny while she gets here?
Second.
Motion and a second. Any discussion? All those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. Wanna welcome Taylor Allen to our board. Taylor, welcome.
Yeah, thank you.
I had the honor of being here for his induction into the board and for his swearing-in ceremony and his part of his training. So welcome aboard, and to those of y'all that haven't met him, this is Taylor Allen, our newest addition to the board. Taylor, any?
Thank you for the introduction. I'm happy to be here and excited to do everything I can to help out the board and TESRS. So thank you.
Thanks. Well, you don't have to drive by yourself from Dallas anymore, Don.
Well, that's right. Could you drive? That was you.
Okay, item 3, approval of the minutes of December 9th and 10th. And I think our ED has included in your red folder some corrections that she made to the minutes for y'all to quickly review, and then whenever y'all have reviewed them, I'll entertain a motion to approve them.
The correction to the minutes is in the red folder. It's the first item.
Do we have a motion?
Move to accept as amended.
Okay, we have a motion. Is there a second?
Second.
And we have a second by Gracie. Any discussion? All those in favor signify by saying aye.
Aye.
Opposed? Motion carries.
Mr. Chairman, I just have a real quick question. Should we be using our mics?
Yes, please, so that they can record you properly. We like to hear your voice.
Well, I do too.
Okay, item 4 on committee assignment. We have Taylor with us, and with an expertise in finance and investments. It only makes sense that we appoint him to our investment committee, and I've met with him, and he's agreed to serve. So again, welcome aboard, and we're going to get you on board, and we're going to keep running.
Great.
And so we're going to get Taylor onto the investment committee, and what else do we have open?
The legislative committee. That was me. Max was on that.
Yeah, done. Actuarial. Gracie, can you sit on the legislative committee for us?
Sure.
Okay. All right, so we'll add Gracie to that committee. And that brings us up to item 5, Executive Director's Report. Ms. Jordan?
Thank you very much. Thank you. Michelle Jordan, Executive Director of Emergency Services Retirement System. Have a bit of housekeeping since the board hasn't met at the Capitol in a while. Susanna has given everyone a map that has the first floor of the extension on one side and the second floor on the other. restrooms are nearby on the second floor, and cafeteria is on the first floor. We will be on our own for lunch tomorrow, so you may want to use the Capitol cafeteria, which is very good. There are also copies of those maps on the table at the back of the room for our visitors to the meeting as well. This meeting is being live streamed from the House of Representatives website, and we've placed a link on our website for our departments to watch it. And after the meeting, we will upload the taping so that folks that did not have a chance to watch it can view it later. We're looking at options on cost-effective ways to stream our meetings, but because of the importance of this meeting, we wanted to use the facilities that were available here at the Capitol. As Frank noticed, there is the on-off button on your mics. You can feel free to turn it off if you need to speak to someone privately or make a comment privately. On our website, we rolled it out last month, and I feel really satisfied with the end result. I hope you do too. We're already receiving about 150 visitors to the site every day. And in the last week, we received an automatic inquiry from the website from either a retiree or a department or an active. And so they are using it, and the more they use it, the better, because then we can make sure we communicate effectively with our stakeholders. So that's kind of exciting. Between the site, the Facebook page, and the Twitter, it's going to all ensure we communicate effectively with our departments. And again, the cost of the website was $35, which was the domain for a year. There are no hosting charges, so I think we saved the state some money in building it ourselves, and efficiencies. Along the lines of communication, we developed a customer service survey and have already sent that out and got all the results back. Susanna is going to give you more detail in a second, but I wanted to thank all of the stakeholders that took the time to respond to that, and hope they'll participate again. It was all very good information, and I'm pleased with the results. And I hope that we will continue to raise the bar on communication and customer service for the agency. I wanted to tell you the update on the move. The latest information from the Facilities Commission is that we will move at the end of June. And I'm told that that's a pretty firm date. So we can count on the end of June having our move. Unfortunately, it looks like we may be able to bounce our board meetings in between that move date. Jessica is going to talk more about it in our report, but I'd have to say that the last 3 months' activities have been very beneficial in improving the data in our system. Between the annual reports that we receive back, which we received in record numbers, a higher number of reports than we ever have from departments, and from sending out the 1099s and getting returns for bad addresses, and sending out the benefit statements and having folks call in with better information. I think that we're improving the quality of the data in the system. We do have a way to go, but we are making progress, and I feel really, really good about that. We are planning on sending out benefit statements in May, since we did get such a good response on annual reports, and I think we're back on track in terms of our reporting. I traveled to South Texas and met Frank earlier this year, and we visited with the City Council of Ed Couch. And I know they appreciated the visit, and I appreciated Frank taking the time to do that. I think that our physical presence in our department areas around the state makes a difference, and I would really like to do more of that. And as we go along, I would like to call on the board members, if they're available, to meet with us with various departments and different functions And I know you've said that you were willing to do that, so we may be doing more of that the next year as we have the time to kind of get out there more. Trustee Key, Dan Key, has been talking with Brazoria County about possibly joining the system, and we've really appreciated all of his hard work on that. He may want to tell you a little bit more, but I know it's in the beginning stages, but there seems to be some interest on their part, and that would be really great to get their participants in our system and get them covered. Did you want to add something to that?
I'll just add that Brazoria County ESD represents 12 to 15 fire departments in northern Brazoria County, down in sort of between Jenny and me. And they expressed an interest in bringing several of their departments into the plan. I went down and made a brief presentation to them during an ESD meeting. We got membership rolls from the departments that would be involved. I sent those up to the office. They worked us up a preliminary cost estimate of about what they could get into the system at the base amount, between 75 and 100 or 125 members, something like that. Sent that information back to them. They liked what they saw, and they've asked us to come back on the 14th, which is a week from Monday, to do a formal presentation to all the fire departments. So I've asked Michelle to try to work that into her schedule to come down and do a presentation for that ESD to bring them in. So we're going to press forward with that if we can.
Good deal. Thank you. Thank you for doing that. Let's see. Many of the large projects we've had going on have been completed, and usually when that happens, new projects appear. So we have a little bit of time, downtime, and then we'll be working on the strategic plan, and then the legislative appropriation requests. SORM, just so you know, has some new disaster recovery requirements that are pretty extensive. They actually require that you get some FEMA training on disaster recovery, and it's quite a few hours, and the staff has had to attend. It's Paul and Susanna that are working on it, and they've had to attend quite a few workshops on that. It's important to make sure that if something happens, we can continue to pay our retirees and conduct business. So that's turning into a bigger project than we thought it would be. But we got that going on. And then the move. The reworking of the pension system by Pension Live is where I would expect it to be right now. Pension Live has had to help us with a couple of things that we did not anticipate, like, and Jessica's going to talk about this too, but the Controller's Office required each agency to change its pay EID numbering system. And for most agencies, you know, that probably wasn't that big of a deal. For us, with the number of payees that we have, it was a big deal. Before, there was a certain algorithm that created vendor ID numbers, and this is a whole different system that's randomized. So, you know, Pension Live had to help, and Judy and Jessica and Eliana worked really hard with Pat to get that done. But the pension system is where it's supposed to be. He helped us get out annual reports as well. In terms of contracts, after talking with Frank and Don, we have determined that it is in the best interest of the agency to renew Rudd and Wisdom's contract for 1 year and then do an RFP, and that would give any new contractor time to get to know the agency before they had to do the evaluation. And same thing with Judy Johnson, because of the legislative session and implementation of some of the GASB things, that her contract would be renewed for 1 year as well. Wanted to let you know about that. On the agenda under 5B, there's an update on the Pension Review Board recommendations. It's on if you look in page 14 of the board packet, we've listed what those recommendations are. PRB was charged with a number of new responsibilities this last legislative session, among them developing minimum training requirements, and this covers trustees and administrators. And so in collaboration with other pension agencies, the PRB had a committee that worked hard to come up with these training requirements. And at their last board meeting, the PRB board move forward with them. And so at the May meeting, they will have rules in front of them to approve to publish that will in effect include this language on page 14. And so basically it requires all new trustees and system administrators to obtain 7 hours of training the first year within these core content areas. And then after that, it's 4 hours every 2 years within either the core or the non-core content. I don't think this is going to be a problem considering the training that this board usually gets. They have been working with TESRS, so TESRS will understand the content that's needed to meet this requirement. But if you want to take a look at this and then let us know, I can be sure to pass on the comments once the rules are published to the PRB. But it has been thoroughly vetted with the pension, most of the pension agencies that participated on the board.
Was there any discussion about certifying what training counts and what doesn't? Or also was there any conversation around documentation and consequences and Chris, all those various...
Chris Hansen is the ED of the PRB, and he's here, and he can correct me if I'm wrong, but what I heard them saying is that they will have certified educational providers, but if the agency has something they think meets the criteria, they can submit it for approval. Is that right, Chris?
That's correct.
Okay.
And then in terms of the documentation, honor system, or?
I personally think because it's a statutory requirement, we would probably want to keep training in the training files in-house in case anybody asked about it. I think the process of if we had a training and we wanted PRB to approve it as meeting these criteria, we would probably have to send them the curriculum to look at. And once they blessed it, then, we could just keep that internally. And again, I'll keep you in the loop I'll make sure you get a copy of the published rules. And if you have any thoughts, let me know, and I'll make sure that it gets to Chris. Any comments?
So there is rules they're publishing rules, I guess it says here by May?
Yes, sir.
That the PRB is?
Yes, sir.
Okay. So when does this?
It goes into effect January of 2015.
Okay. So I'm assuming in the rules you're going to have the process and policies and procedures on what you need to do to make sure that you're in compliance.
I bet they will.
Okay.
Will any professional education that might meet this criteria would that be able to be submitted for approval?
To some extent with the non-core, I think the expectation as it stands now is that the core would focus on pension-related matters. Non-core, so open records, public information, certain things that overlap will count probably with CPE from Board of Accountancy. We're still working through some of that, but the core itself is designed pension specific, so that
Right.
first year of training. To the prior question about certification, we'll have accredited sponsors. We're working with TESRS and other groups. We are looking at our next working group meeting in 2 weeks about accrediting prior training at maybe a TESRS or in CPRS where you were on a certified path, that could count towards core for existing trustees. But we have a lot to resolve on those issues between now and May 14th.
Thank you.
So, what you're saying then is if we had TESRS hours in the pack or the C, are those bankable hours or is it 4 hours?
It's being considered.
Okay.
And there may be a look back at the last 2 years, and it would need to be in the trustee track, not just you attended TESRS, but you were part of the certified trustee training. There is some expectation that if you did in the last couple of years, I don't know if it was 10 years ago, probably won't count, but if it was in the last couple of years, I know the working group is looking at that and the board will consider their recommendations seriously.
Because I know through TESRS you had to do Part A, Part B, Part C. Once you got certified in those.
And I think that the TESRS is on our working group. We're going to be working with Max and Barbara as we move forward to see. I think the expectation is, over the last maybe couple of years, if you completed all 3, that then you would be certified in the core. I can't speak for what the working group will ultimately decide, but that's one of the main points of discussion at the meeting in 2 weeks.
For my particular job, I'm the administrator for an ESD. I've had to go to North Texas State for some financial classes to be certified for what I'm doing. Is that stuff that we would send to you and see if it's going to be acceptable, not acceptable?
Yes, and we're going to develop in the rules that process so that it's completely transparent and laid out what the expectation would be in that regard. It'll be similar. We've been working with the Board of Accountancy and State Bar to mirror a lot of what they've done in that regard.
Thank you.
Thank you, Chris. I know the PRB was mandated to do this and to make it happen, so appreciate their work. I wanted to quickly update you on the volunteer retention study. If I can refer you to page 28 of your packet. We began the volunteer retention study in March. We received a total of 77 participants that are listed on that page 28. Departments include both volunteer and combination departments, and about 1/3 are TESRS, the rest are not. And I wanted to just point out, even though we know which departments are participating, they are not going to be linked to the data they provide. We allowed them to self-assign a random ID number. We wanted to make sure that they didn't have any concerns about the information harming their department in any way. So we started in March. The deadline for providing the information is at the end of April. And as of today, about 25% have already submitted their data. They are all very enthusiastic. I receive emails every other day, asking questions about how to calculate certain aspects of the study, and comments about how eager they are to learn what retention programs other departments are using, because it is a vital issue to them right now. So towards the top of page 28, we've listed the timeline for the study, so you can see that we're still in the data collection phase. We're hoping that prior to the session we'll have the study results in our hand that we can use for the benefit of fire service. And wanted to make sure I thank SFFMA and VFIS for helping us get the word out and getting the departments that we have. On page, you can see, Dan, did you want to add something?
Well, I only wanted to ask if, number one, if 77 respondents is going to give us
it will
sort of a representative sample.
I think it will be representative. It will not be statistically valid. We needed to get when I calculated it, we would need about 160 to be statistically valid. However, we do have all of the data we're asking for in-house from our own departments that we collect during the annual reporting process. It will be a manual process to go through and find 85 more to use, but we do plan to use that so that they can be combined. It can be a benchmark to see if our study results are a good match, and so we think that was a good solution. It's hard when you're working, volunteers that are working so hard to begin with, and then we're asking them to, spend quite a bit of time on top of that. So I was really glad to get the 77 participants, and I think, once we get the results and the studies published and they see, some of the fruits of that labor, we may in future get more participation.
Is it too late to put out another request for departments?
It is not too late. I went to that well several times since the beginning of the year, but it's not too late. We've tweeted about it, and on our Facebook that they can join anytime, and as long as they can get us all the data by April 30th.
What do you think the time commitment is for a department to come up with all the information?
For a department that is more sophisticated, I think that they will have an easier time. Maybe some of the smaller departments may have a manual process for a lot of this and may have to dig. I think it could probably be done in 10 days if there was a concerted effort. And just so you know what we've asked them to provide, it starts on page 15. 15 through 27 is the actual survey data collection tool on SurveyMonkey that we've asked them. And basically, it looks like a lot more than what it is. We've asked them the number of volunteers at the end of every year for 5 years. We've asked them the ages of those volunteers. We've asked them to tell us why people leave, why they think people leave. Questions that we can, what part of the state they're in, the population of the area they serve. The questions that we're asking is going to give us pieces of data that we can manipulate in the analysis phase to come up, I think, with some data that we haven't had before on retention. We hope, if all things go as planned. Are there any questions on the retention study? All right. Next is the item related to approval of a new ethics and conflict of interest policy. You'll find this on page 29 of the board packet, where we have included a draft for your approval. This policy was borrowed from the Pension Review Board's best practices and developed through a collaboration of state and local pension bodies. I noticed when I looked into the development of this policy that they did a lot of research on statutory requirements of trustees and boards that made me feel really good about it having been thoroughly researched from a legal perspective. And because of the amount of time and effort that was put into it, it seemed like it would make sense to at least start with their policy. And that's what this is. This is basically their policy. And then in blue, I've added language to extend this policy to cover our own employees. I did that because I want to make sure that we, the employees as well, are bound to a higher standard of conduct given our exposure to the investment arena and the public trust. On page 37 is the previous policy that the board had for your reference. I'd be glad to answer any questions, but what we're asking the board to do is to approve this policy as a replacement to the previous policy, subject to a final review by the Attorney General's office.
Does anybody have any questions? Does everybody had a chance to review it? I think they were not in our original packets. And I think this is something we've been talking about for a couple of meetings now, so. We'll entertain a motion to approve the ethics and conflict of interest policy as presented.
I move that we accept the ethics and conflict of interest policy as proposed.
Subject to the AG's.
Correct.
Right.
Subject to the AG's approval.
I'll second that.
Okay, we have a motion by Gracie Flores and seconded by Don. Is there any questions or discussion? All those in favor signify by saying aye.
Aye.
All those opposed, same sign. Motion carries unanimously.
Now I want to ask Susanna Jones to give us her report on the stakeholder survey.
Page 30.
Good afternoon, board members. My name is Susanna Jones. I'm Executive Assistant with the Texas Emergency Services Retirement System. I'm going to go over the 2014 Customer Service Survey on page 40 of your board packet. The purpose of this survey was to satisfy the reporting requirements of the Legislative Budget Board and also give us a valuable information on the level of customer service we provide. I'm going to hit the highlights and then happy to answer any questions you may have. Respondents reported that they were very pleased with the level of customer service we provided with an overall customer satisfaction rate of 95.77. Respondents were local pension board members, active volunteer, system retirees, as well as others. Others were fire chiefs, utility office supervisor, CFO, pension administrator, and administration. On page 41, the direct agency experience within the last year was an overall percent of 79.52%. On page 44, how would you describe the way the agency provides information? There's two variables. One was via email at 55.71% and over the phone, which was the highest percent of 64.29%. Both of these were very concise and informative information. On page 45 of your board packet, one of the questions, have you ever visited the agency website? 87.65% of the respondents have visited our website. On page 45 as well, do you use social media to obtain information on issues that affect you? 45% that visit often or frequently have used social media. We gave respondents an opportunity to provide additional feedback and were overwhelmed at the number of voluntary responses we received, which we predominantly were positive. We received positive feedback as well as negative feedback. The positive is located on 46 of your board packet, and the negative is on page 48. At the end of the survey, we gave respondents an additional opportunity to offer feedback and suggestions that the board may want to consider in the planning session. I'll be happy to answer any questions you have at this time.
I personally was very pleased with the results of the survey, and often folks don't make a voluntary response, like leave a comment, especially one that's positive. If they're going to take the time to do it, a lot of times it's negative. But the number of positive responses was very encouraging, and it's good to receive that. It's a confirmation that we're headed in the right direction. And I did take the negative comments to heart. Some of them were related to the previous agency. Some of them weren't, but we will take them all into account and try to do better. And I hope that in the future years we'll get even higher participation, because I do believe in the process of soliciting feedback and then making change when you need to.
If I may just add, in glancing over the negative feedback, I just want to reinforce the fact that those negative experiences that are pointed out in here seem to go back in time, 3 years prior to 13, definitely before we even started this transition that we're in now. And I think there's obviously a new sheriff in town, and new staff coming on board, coming up to speed. And I don't think we'll get this kind of negative feedback in the future. I think we're doing exactly what we need to be doing to keep any negatives to a minimum. Thank you all.
Thank you.
I'd like to thank the staff and also comment on or expanding on Dan's comments. I've heard nothing but positive feedback. The places that I've been to, the meetings that I've been to, and from the people that we serve, and they're very happy with what our agency is doing and the improvements that have been very noticeable to them out in the field over the last few months. And on behalf of the firefighters that we serve, and me personally as a board member, I want to thank the executive director and her staff for helping us get to where we're at today, and we really appreciate everything that y'all do. Thank you.
Thank you. Thank you, Suzanne.
Thank you.
I think now Jessica is going to report on departments' visits and system participation.
Good afternoon, Chair and Torres and members of the board. For the record, my name is Jessica O'Brien. I am the Benefits Supervisor for TESRS. I am happy to be here today and discuss the process of the TESRS team, which includes new department recruitments, department annual reporting, payroll 10 conversion, department presentations, and future projects. I am pleased to announce that we've had 6 departments contact our agency regarding information of our pension system. We supply them with brochures and flyers. Of those 6 departments, we have had 2 applications come in to request to join our pension system. One of those departments is Northwest, which is part of Harris County, and Pecos, which is the department merging from the TELFRA system. Separately from reaching out to those departments, Eliana Martinez, Brianna Loeb, and I have been busy this past quarter with the annual reporting. Annual reports is a detailed report that provides all service credit for members of each department. We had a tremendous amount of reports received by the deadline of January 31st. All departments were in compliance with an exception of one. This year's dedication to communication outreach supersedes the number of reports that we've received in the past years. Good job to those teams. In addition to annual reports, Judy Johnson, Pat McGuire, Eliana, and I met with the Texas Department of Controllers of Public Accounts. The Department of Controllers of Accounts had a TENS payroll conversion. The project removes an individual taxpayer identification number that was printed on paper warrants, which replaced Social Security numbers. And we replaced those numbers with randomized series of numbers. This project was successfully completed on our first attempt of the supplemental payroll, which we did in March. We have also implemented procedures to accommodate this new process in our internal service retirement application setup. Regarding department presentations, Brianna and I have met with Travis County ESD number 6 to provide an overview of the agency. We familiarized them with the website, the forms, and we also helped them with the annual reports. Future projects is the TESRS team will begin working on sending out benefit statements in May. We are also working on data cleanup. Eliana has begun this process already in reviewing all our payees and making sure that our death audit reports is kept up to date. This concludes my presentation regarding the report of benefits, statement participation, and department visits. I am happy to entertain any questions you may have.
Any questions?
Thank you.
Thank you.
And now Judy is going to report on the pension fund.
Good afternoon. For the record, this is Judy Johnson. I'm the contract accountant for Texas Emergency Services Retirement System. If you could turn with me to page 53 of your board book. This is the combined agency budget. Our last board meeting was the first time that we had used this format. So maybe we could just go over it in a little bit more depth, and then if there's any questions, I'd be glad to entertain those. You'll see here 4 various boxes that are highlighted. The first one of those gives the budget for both the Fund 1 general revenue, and the second section will give you the budget for the pension fund, the trust fund 976. If you look in the second box under current use of budget, under Fund 1, you will see the actual expenditures through 3/17 when this report was done, and approximately 50% of the year has elapsed at this point in time, and for the Fund 1 budget we've spent right at 50%, 49.8%. If you will look at the supplies line item of the budget, you'll see the greatest variation in that particular section, and there's a couple of reasons for that. It all kind of rolls up into postage. Because in 2013, of course, we were operating in two different legal entities with different EIN numbers, we had to send out two entirely separate sets of 1099s. So basically, we sent out to pretty much all the retirees two 1099s, one under the agency 325's EIN and then one under 326's. So obviously, that increased postage. Another reason for that increase is we did send out benefit statements, as Michelle had talked about earlier. We sent those out in December, and this is the first time in several years that that had been done, so we didn't really have the historical information to base budgetary information on. And we will be, of course, sending them out again, the 2013, later this summer. If you, okay, let's go back and look at your fund, the pension fund, and you can see under the current use boxes that so far this year $230,500 has been spent, and we'll look at that. You can see that in detail actually on the next page on 54 as far as the vendors that where that money had been spent. That is the report that you're used to seeing, and we'll go over that in just a moment. I'd like to draw your attention, though, to the last box, and that is the estimated annual use of budget. This is kind of a deviation in our reporting, but hopefully it will be helpful to you. What we've done here under the total obligations is taken the current expenditures and then tried to project those expenditures through the end of the year. So with under Fund 1, we anticipate having almost $31,000, $30,900 left over at the end of the year, or at this point in time, our projections indicate that we will have an excess. With regards to the trust fund, you will see under the over-under box that we anticipate having $20,000 left at the end of the year. And basically what that $20,000 is what the line item that you had in your budget for the state auditors. And of course, they were kind enough to waive their fees this year, so you will have that left over in your budget. Are there any questions on the combined budget? If not, let's go to page 54, which does detail the budget and expenditure by vendor. The things I'd like to bring to your attention here is under the investment management fees. You'll see Peer has expenditures so far this year of $30,591. And that does include a 2013 incentive fee of $21,000. This is the first time in several years that we have paid that, but that's a good thing. And the rest of the investment management expenses are through the fourth quarter or through December of 2013, except for Luther King. So as of the date of this report, March the 17th, you have spent 33% of your of the board budget. If there's no questions, let's go on to page number 55, which is the investment activity expenses. What I'd like to bring to your attention on this report is if you'll look in 2013, calendar year 2013, under quarter 3, there is a combined number for State Street, Bank of Texas. That transition, of course, occurred. We were using State Street in August of last year and Bank of Texas then starting in September. So that third quarter number is a blending of those two entities, State Street for 2 months and then Bank of Texas for 1. And obviously you'll see where 2012 compared to 13 is significantly higher due, of course, to the increased market value and resulting money manager's fees because of that. On page 56 is a current asset valuation report, and this was done as of March the 18th. Your total market value is at that point in time was $88.6 million, which reflected an unrealized gain of $26.1 million at that point in time. If we could go over to page 57 now, this is a picture of a graphic presentation of what we anticipate the cash position to be for the next 13 months. And you can see the dip down in June. So it is anticipated that we will need to draw down another $200,000 from the custody bank at that point in time. This is somewhat depending on the market values that for the second quarter that we will be paying the money managers. So depending on what that is.
So Judy, this makes $300,000 for the year out of the $500,000 was authorized, right?
Yes, it does. We have drawn down $400,000 so far, and $300,000 of that was just recently in March. So of the $500,000 that was authorized, we have drawn down $4. So obviously, if the anticipated needs are $2 in June, then I would like to ask the board to consider increasing the authorized amount by $150,000. So from $5,000 to $650,000. I'm not sure if y'all want to do that now or wait till.
Judy, why do you think that is, that it's $650,000? Is this unusual compared to, I mean, the budget itself? Is it that in the past we've just had the cash available?
There are a number of reasons for it. One reason is the demographics of the plan. Whenever we start talking about the pension payments shortly, the average pension payments over this fiscal year have been $340,000 per month. And if you looked at this time last year, you'd probably be seeing something closer to $320,000. So there is a factor there, I think, that's reflective of the demographics of the plan. There's also a factor concerning our money managers in that previously, whenever we were using Brandis, their fees were incorporated and rolled up into the settlement fees, so we didn't have to write a check to pay for those fees. They were netted out. Now, with OFI, we are having to pay those fees, and if you'll go back to page 55, you can see there for just looking in calendar year 2013, we paid OFI $30,000 for first quarter, for second quarter about $30,000, $33,000 for third quarter, and $35,000 for fourth quarter. So that's pretty significant in itself. So I think the cash situation, it is a little unusual situation that we're in, but those are pretty much the reasons.
Thank you. So I think that this means next year we would need to have obviously $650,000 authorized instead of $5.
Right. And of course, it's and the other reason has to do with money managers also, obviously, because of our increase in market value, we've been paying out more in money managers' fees, which is a good thing. So that premise is based on the assumption that we are going to continue performing well. Also, the current Treasury interest rate now is 0.41%. It's gone up a little bit.
Now, it doesn't look like we have enough cash to fund the additional draws that you need. Would we want to indicate what investments to liquidate to cover it, or do we just do that kind of across the board?
The methodology for that has traditionally been that when that draw was needed, I would contact Milliman with the current asset allocation now, giving them that information, and they would come back to us with a recommendation as far as what we needed to use for that. And then at that point in time, that correspondence would be sent to the investment committee just for their kind of final approval.
Typically what Milliman does is they look at our asset allocation and see where we're over and take it from there. That's typically
And again, most of the managers have a cash position anyway, so it's not like you really have to liquidate investments. Typically, they'll just take some of their cash,
Sure.
and we tell them that we need to draw $100,000 out, so it's a fairly quick process, I understand. But so in other words, we can go ahead and move and approve now. We don't need to go to the investment committee to handle this issue.
We don't.
So, shall I go ahead and make a motion?
Right.
So I'd like to move that we authorize an additional $150,000 be drawn out to cover our cash needs as needed for the remainder of the year.
As per our policy.
Pardon me?
We just follow the policy that we do it all the time.
Yes, following.
That we follow every time we need it.
Yes.
All right. So I've got a motion by Don. Is there a second?
Second?
Second by Gracie to authorize an additional 100,000.
150.
150 to our cash draw if necessary for operations. Any discussion? Okay, all those in favor signify by saying aye.
Aye.
Opposed, same sign. Motion carries. All right, Judy.
And if this cash withdrawal is not necessary in June, then due to the cash flow and the timing of the contributions for the departments, the next anticipated date would be between August and September. So again, we'll analyze the cash position as we know more about what those money manager fees are going to be. So. Okay, on page 58 is the contributions by department report. And basically, these contributions are reflective of 2 quarters of contributions. And if you'll turn to the very last page of that report, page 62, then you'll see that our contributions so far this year for the 2 quarters have been $1,975,000, and that equates to about $987,500 per quarter. Also reflected in those contributions, we have about a $230,000 amount from Edinburgh, which was the end, their last payment from coming into the system. So, we'll turn now to the pension payments report on page 63. This is through the month of February, from September through February. And if you'll move on to the last page of that report, page 66, we have sent out in pension payments a total of $2,043,000 for that time period. And as we talked about a while ago, that does equate to about $340,000 a month for that time period. On page 67 is our prior receivables under the prior service contracts, and that number is $280,000 as of right now, $280,535. The last thing I'd like to talk to you about is on page 68, and I probably should have brought this up when we were talking about the budget a while ago, but we had talked about the supplies being over because of the postage. So based on the board actions last time, I would like to recommend that a line item adjustment of $18,000 be made to increase that supplies budget. And if you'll look on page 53 at the combined budget, we had talked about having about $30,900 left over at the end of the year, and you'll see where the majority of that is in the area of professional fees and services. So I would like to recommend that $18,000 line item be transferred from the professional fees to the supplies line item.
Go ahead.
I was just going to add that when Judy and I looked at this, we tried to anticipate what the cost for this new statements that are going out will be through the end of the year. And they are costly because sometimes they're as much as 3 pages long. So this budget is just to cover us what we think we'll need to cover through the end of the year. And we had a little freed up in the, as Judy said, in the professional fees line item. Seemed like the obvious place, but it is. I mean, it's a net effect. It doesn't impact the $30,000 available budget.
I'll make that motion, Chairman, that we move $18,000 from professional fees to the line item of supplies.
Okay, we have a motion by Dennis Rice. Is there a second?
Second.
A second by Dan Key. Any questions? Any more discussion? All those in favor signify by saying aye.
Aye.
Opposed? Motion carries.
Thank you. The last thing I'd like to bring to your attention is you should have in your board packet the 2013 audited financial statements. And the State Auditor's Office, we do have a representative here today that's going to be giving his report on that, so I just wanted to bring that to your attention. That's the report that he is going to be referring to.
It is a separate bound report, and then the State Auditor's letter and report and our response is in the board packet itself.
Okay, does anybody have any other questions for Judy? Thank you, Judy.
Thank you.
Okay, Michelle, on update on request for outside counsel?
Yes. I wanted to just give you a quick update. We did submit the request for outside counsel to the Attorney General's office, and it was approved. So we developed a contract, which was also approved by the AGs and executed. It is in your board packet for informational purposes on page 69. Our contract with Jackson Walker is now active through August 31st of 2015. And he's available to assist us with the IRS determination letter and any other legal matters that we may require. Judy, Jim, and I have scheduled a meeting with Chuck Campbell from Jackson Walker in a few weeks to discuss the projects that we would like him to work on. So just wanted to let you know that that's in place.
Okay, thank you. Okay, item 6, presentation and discussion of the 2013 audit of the State Auditor's Office.
Good afternoon, Mr. Chair, board members, Ms. Jordan. My name is Cesar Saldivar with the State Auditor's Office. I'm an audit manager. I was an audit manager on this financial opinion audit. With me this afternoon, is Lisa Collier, Assistant State Auditor. On December 20th, we emailed a document to the board entitled Required Communication with Those Charged with Governance, and that is a standard document that we provide to those charged with governance for our financial opinion audits. Some of the items that are mentioned in that document are pretty standard, talking about we did not identify fraud, the staff, Ms. Jordan, and the staff were very cooperative. They provided everything to us that we had requested. On that same day, December 20th, 2013, we issued out an unqualified opinion on the financial statements, which is good. We also issued out a report on internal controls. That report contained two findings. The first was a reissuance of the lack of controls over information systems finding that we've had the previous two years. So we reissued that one. That one basically had to do with some user access and weak password controls issues on that finding. The second finding was a controlled environment finding that was in place during the scope of the audit, September 1st, 2012 to August 31st, 2013. We discussed some of those details with Ms. Jordan and her staff, and they did respond, and that is included in that report as well. I would also like to add that this year, Mr. Keel, State Auditor, agreed to waive the fee for our audit services as well. That concludes my prepared testimony. If there's any questions, I'll be more than happy to answer.
Any questions? Thank you very much, Mr. Saldi. Okay, let's take about a 50-minute break, and we'll come back and look at actual and audit matters. Okay? I think in talking to the committee chairs, they all want to just do the committees all as a whole instead of breaking up out into the different rooms. So we'll break for about 15 minutes and we'll come back and start with actual and audit matters here. Okay, it's 2:35 p.m. Let's reconvene the meeting of the Texas Emergency Service Retirement System. Let the record show we still have a quorum to conduct business. And I think we're up to actuarial and audit. And at this time, I'm going to hand the meeting over to our committee chair, Mr. Don Shipman.
Right. And if I could, I'd like Mark Pamela from Rugby Beacon join us at the table there. Pretty much all that we want to talk about in this committee relates to our efforts to bring the plan back to an adequate funding arrangement. As I think everyone here knows, the last actual evaluation, the August 31st, or I guess September 1 of 2012, indicated that the plan had a $33 million unfunded liability. And the contributions by departments were sufficient to cover 10, 11, 12 million of that. The contributions that we received from the state, assuming the maximum allowable contribution is received from the state, would cover another 10, 11 million of the unfunded, but that still left us with a $10 million unfunded that we had no funding to cover, and that's, in a sense, the definition of an inadequate funding arrangement. We had no way to cover it. So we embarked on an adventure, if you will, to try and come up with ways to alleviate that $10 million of underfunding. Initially, our work, the actuarial and audit, and the board and the actuary here, we're looking at benefit changes as the only practical way to deal with that large of an unfunded. The plan itself is, again, in round numbers, a $100 million plan, and so $10 million is a pretty big chunk of a $100 million plan. And so we were concerned that it would take some fairly significant changes in the plan to bring us back to an adequate funding arrangement. Where we went with this, and we had a committee meeting, I guess it was in March, to address and look at some of these options. The original options that had been discussed with the board at our earlier meeting included changing the earliest unreduced retirement age to age 60. You could still take a benefit at 55, but there would be a reduction in your benefit. That was one of the options we looked at. Another one was to take the 6.2%, I'm just going to call it the growth factor, and reduce that to 5% for people who have more than 15 years of service. And then we looked at various ways to combine them and grandfather certain groups and so forth. So we had a collection of options, and that material is in the book. You don't really need to go to it, though, because while the committee did review those options, and Mark even provided some benefit illustrations so that we'd be able to go back and tell people, here's the effect it's going to have on you. So we had that document prepared as well, and those both are in here. Where we eventually started to work towards, though, was a somewhat different approach. And there were two elements that we wanted to look at fairly hard. One of them would involve increasing contributions. Now, normally, under the plan as it's now written, if you increase contributions, you increase people's benefits. You increase people's benefits, the liability goes up, the contributions go up, the liability goes up, and you really don't get yourself much help as it relates to an unfunded obligation because you're increasing benefits at the same time. However, Michelle, and I think she'd worked with Jim somewhat on this, looked at what was allowable, and the feeling is that by rule, this committee should be able to add a supplemental contribution that's not part of the benefit formula itself, because the $36 is, if a department's doing the minimum, drives the benefit the individual gets. However, there appears to be the ability, should this committee decide, to add a supplemental contribution, might be a temporary one, that could be used to bring us back or partially bring us back to an adequate funding arrangement. And we'll talk more about what we had in mind there. The other element that we looked at, and I think this was one that was certainly prompted somewhat by our friends from Pasadena at the last meeting, was obviously the best way to take care of the unfunded is to have investment gains. I mean, have the markets take care of our unfunded for us. And so we wanted to take a much harder look at where we thought we would really be by the next actuarial evaluation. What would the markets have already done for us in the way of alleviating that $10 million that we were trying to deal with? And so we've headed off on that path. The problem with the assets working for us, though, is that under our actuarial evaluation methodology as it currently exists, when we have a nice big actuarial gain on the assets, we only recognize part of that. We kind of pretend it's not there when we do the actuarial work. So, for example, we might have, by the time we get to the end of this fiscal year, we might have $6 or $7 million of assets that we're sort of pretending we don't have. Now, we do it the other way around as well, this what we call asset smoothing method. The whole point of it is so that over time, you don't reflect every time you do evaluation big increases or big decreases, because several years ago, what we had were a bunch of losses that we weren't recognizing. We were pretending in doing the actuarial work, and as part of our methodology, that we had more money than we had in the plan. It just happens that now, because we've had several years of gains, under the actuarial approach we use, by the time we get to August 31s, we anticipate that we'll be pretending, if you will, that we have a fair amount less assets than we actually have. And part of our thought process was, man, it might not be appropriate to cut folks' benefits just because we want to pretend we don't have as much money as we have. And so, as one aspect of trying to deal with our shortfall and our inadequate funding arrangement, there is the ability of the actuary to do what we call reinitialize the asset values. So instead of pretending we don't have 5, 6, 7 million that we do, we simply restart the whole thing. We don't go to where we're reflecting market 100% in future years. We simply say we're going to pretend like we're just starting this up now and set it to market value. That reinitialization is an approach that has historically been used a fair amount in different environments, not so much probably in the public plan arena, but it has been used. And so we wanted to look at that. So we ended up, while really appreciating the work that Mark did on the various benefit changes, the early retirement change and the 6.2 going to 5% change, we ended up pretty quickly thinking that there is a real possibility that these other two ways of doing things might actually take care of us at the next valuation without a need to actually impact the firefighters and the firefighter benefits. And so I think at this point, perhaps, would this be a good point to have Mark look at what became the final study?
Yes, I think this would be Mark Finlaw, Rudd and Wisdom Consulting Actuaries.
And and I forgot to mention it, the latest study that related to proposals is in your red packet.
It's dated April 1st and is titled Supplement to Special Studies.
But do not worry. Mark is not going to come to the end and say, April 1st. He's promised he's not going to do that.
Before we look at that one, I just want to talk about one of the reports that we discussed at the March 7th board meeting had been requested at the December board meeting, knowing that the investment markets had been good. They said project gains on see what we might have August 31, 2014. So in that report dated February 28th called Projected Gain on Assets, we looked at the actual investment experience through August 31, 2013, and the system had a market value rate of return of 13.84%. So
just real quick, I think, are you referring to the 100, page 119, I think is probably, or you're referring to that earlier report of yours? The February 28th, and the pages are 116, 17, 18, 19, thereabouts, in case.
Yes.
And I think there is a schedule in there.
Page 119, that's right.
That's probably where you're going to want to end up, is 119. So.
Yes, good. So there was keeping, the approach where we measure investment gains as the amount of dollar earnings above the assumed 7.75%. So in 2013, there was a gain of $4.1 million. And we did a sort of a what-if, an estimated scenario in this Exhibit 2 for 2014, the fiscal year ending in 2014, assuming that the rate of return would be 18%, and that produced a gain of almost $8.2 million. And that then is what led in the March 7th Actuarial and Audit Committee meeting to talk about, well, maybe if we look at if the investment experience does continue to be favorable through August 31, 2014, and if the board rules are changed, enhanced to allow additional contributions by the participating departments, which we're referring to as Part 2 contributions in the board rule that will be looked at later. And those are, as Don said, not to increase benefits, but to help amortize the system's unfunded actual accrued liability. And then the third piece of the puzzle was, and if the actuarial value of assets methodology is modified to temporarily reset the actuarial value of assets to be the market value of assets, then would it be possible to avoid any benefit changes, any benefit reductions, or changing the retirement age? So that's what we looked at in this report dated April 1st called the Supplement to the Special Studies. And we looked at 4 different scenarios. And the first, if you go ahead and just look at the attached exhibit, and let's see.
There's one thing on page 119 I want to just make real clear with everyone. On page 119, the reset or the reinitialization is talking about, assuming we had the kind of investment return that was being modeled in this page, was it's about 2/3 of the way down the page where it says deferred gain loss amount as of August 31, 2014, and there's a total there of $9,890,000, almost the $10 million we were looking for. So that's the number that we're talking about. That if we had this very favorable investment performance, which this is in his later study we didn't assume as favorable a performance, but that's the number that we wouldn't have been recognizing unless we reestablished. We'd have that $9,900,000 almost, and we'd be, in a sense, pretending it didn't exist.
Well, we would be deferring recognition of it.
Deferring recognition.
I don't like to pretend. I like to defer.
I understand.
The letter did say that even if we kept the method the same, we would have had a gain of $2.7 million. The 9.9 would be in addition to that if we were to recognize that. So you'd have almost $13 million total recognized investment gain if you were to reset it under that scenario. But we looked, now going to the April 1st report and looking at the exhibit, which is on the 3rd page of that, we looked at 4 different approaches. The first 3 were, we said, okay, what kind of investment experience would we need to have if we had these Part 2 contributions of 15%? Or what investment experience would we have to have if we had investment experience of, Part 2 contributions of 10% or 0? In other words, what would we need in the way of investment return to avoid changing the benefits if the board is amenable to the idea of these Part 2 contributions, and the Part 2 contributions were at these 3 different levels: 15%, and that means that the Part 1 contribution would be multiplied by 15%, and that would be the additional contribution for amortizing unfunded. 15, 10, or 0. And you can see on item number 9, the very bottom, is that the market value rate of return would need to be 11.12% with the 15% Part 2 contributions, 13.71% with 10% Part 2 contributions, and 18.90% with no Part 2 contributions. And then the study D, the fourth scenario, was just to look at what was the market value of assets in Milliman's February 28th flash report, and then we adjusted that to the end of the year, just assuming the 7.75% annualized return for the last 6 months, and we made adjustments for the last 6 months for the expected contributions coming in and the expected benefit payments. And then we calculated the rate of return to be, in that case, 14.89%, and then we solved for item number 7. In that case, we would need Part 2 contributions of 7.7%. Now, I want to draw your attention to the wording on item number 7. It says Part 2 contributions as a percent of 5, assuming the state makes the maximum state contribution of 1/3 of expected annual contributions. So all of this, and this is in the 2-page report as well, we try to put in the underlying assumptions. And one of those assumptions is that the state legislature will continue to appropriate the maximum state contribution. Now, since the state law defining the maximum state contribution does not distinguish between Part 1 and Part 2 contributions, we took the conservative position that the legislature would appropriate 1/3 of the Part 1 contributions. But as we discussed it in the Actuarial and Audit Committee meeting, the LBB will tell us what's appropriate. That's sort of a legal question, because Section 865.015 just says 1/3 of all contributions, but of course when that was written, the only contributions we had were the Part 1 contributions. Well, I guess there are merger assets. There can be some extra contributions from time to time, and prior service contributions, buyback. So this just lays out, I guess, a range of possibilities if the board is desiring to do all you can to avoid changing the benefits. And really, anytime you're faced with the possibility of having to reduce benefits, one of the things I think that the actuary needs to do is, look at all his assumptions and squeeze out any conservatism. And so the change in the value of actuarial value of assets methodology is one way of looking at it, is that's just squeezing out the conservatism you have at that point in time. And so to me, that is a legitimate approach.
Right, and again, this isn't the sort of thing, this reestablishment would not be the sort of thing we do just to do it. It's more a matter of as you say, the only reason we're talking about it is because we want to do everything we can to avoid benefit reductions.
Right. We would never talk about this as a way to try to give benefit increases.
Correct.
At least I would be throwing a fit if y'all were.
Right. But in a sense, the complement to this situation is if you have an unrecognized loss, and we were in a surplus position because of an unrecognized loss, you probably wouldn't allow us to increase benefits in that case either, right? So in that case, you squeeze out, if you're going to increase benefits, you kind of you squeeze in the conservativeness or leave it in. Anyway, that's so much the actuaries talking to each other. Yeah, go ahead.
For the benefit of those that might be watching this on our website or anyone else, so are you saying that if the actuarial method was changed, if there was a contribution between 10 and 15%, and if we make between 7 and 9 million, your estimate is that the system would be able to amortize its liabilities within 30 years?
Yes, all of this is using the 30-year amortization period that's in the state law. It is assuming that those Part 2 contributions would be made for 30 years.
Thank you.
It would be done, it would be, the way we talked about it in the committee meeting, it would be adjusted every 2 years. Every time we did evaluation, we'd see, could those be reduced? Do they need to be increased? But we would look at that.
Yeah, and in terms of the real technical aspects of what we're proposing in the way of the rule, we're saying that every 2 years after we get the actual evaluation, this board may require somewhere between 0 and 15% surcharge or contribution, tier 2 contribution for the next 2 years, beginning on the fiscal year. So the way it would actually work, to give people time to realize, and departments time to realize that there's going to be an increase or a decrease, is that we would get our actual evaluation in December, say, and this board would meet in December and finalize things in potentially March, but they would be effective, whatever we said that this extra contribution was, wouldn't begin to be effective until the next fiscal year. In other words, September 1 following. And in the rule, we actually are saying, now we're not going to make this unlimited. It can be anywhere from 0, this extra contribution can be from 0 to 15% of the regular contribution. So that's the top. So for a 36, if we went to the top, the 15%, and an organization or department is contributing at 36, there'd be an extra $5 per firefighter that would need to be contributed. That would be the top end of what would be allowed under the rule. And by the way, Michelle, there was one other assumption in this that has to be met in order for it to work, and that is that we don't have a lot of other losses that pop up, ignoring the investment side, but pop up in the actual valuation. Remember, we've gone through a pretty massive data restructuring, system restructuring, data cleanup, and I think, Michelle, you and Mark and I, we've all discussed the fact that whenever you clean up all your data, there's a fairly good likelihood that some kind of a wiggling in your liabilities is going to appear because you've got new data. And we've seen that happen already in prior years, where you'll have what we call an actuarial loss on the liability side. So obviously, this structure is getting us pretty close to the line, but if suddenly the benchmark moves 3, 4 million, 5 million, whatever, because of the better data, well, then we'll be probably still talking, unless we get really good asset performance.
Yeah.
Another thing
thank you for mentioning that, Don. Just for full disclosure, in the letter on page 2, the next to the last paragraph includes those things you're talking about. In other words, we're assuming no changes in benefits, no changes in actuarial assumptions, all non-investment experience exactly follows the underlying assumptions, and no material changes in the census data.
So Mark, the reinitialization, or Don, the resetting point would be August 31st, 2014?
Yes. And then from that point forward, we would go back to the 5-year smoothing. So in the 2016 valuation, we would have had 2 years of experience, and we would measure gains and losses in those 2 years, and we would do the 5-year, we would defer the gain or loss in that first year. We would be recognizing 40% and deferring 60, and the second year we would be recognizing 20 and deferring 80. So we would build back up to the full 5 years.
And just another little point regarding the schedule in the supplemental letter here, the schedule on the back. The study A, where the requirement is 11.12 market rate of return, that we already actually, within a few tenths of a percent, that we already had in the bank as of February 28th. That's about where you were, wasn't it?
Well, I want to be a little bit more guarded because we don't really know what's going to happen between now and August 31.
No, I understand that, but I'm just saying that scenario actually has pretty much a zero return from February 28th till August 31.
Well, but if we had a negative return between now and then, It could.
Understood. I'm not saying it's the worst case. I'm just saying that is the one that we could lose 10% between now and the end of August, and this conversation is over.
And as we get closer to the August meeting, we'll have a better idea.
We'll have a better idea.
And then that rate goes back to the 7.75 from that point on.
Well, the 7.75 is the underlying long-term investment return assumption.
Right. But if
we're not changing that.
Right. But the rate of return here is through August.
That's the market value rate of return for the current fiscal year through August 31.
I'm just saying that's not assumed from
No, that's not an assumption. It's just a projection of what the market value rate of return might be for this year. Good point. Yeah.
And so again, the only action really at this point that we would need to take would relate to the rule, if you will, that's going to be discussed further in the Rules Committee. But the rule would need to be, authorized, approved for public comment. That's going to have to be approved in order for it to go into the Texas Register. And then we'll have to really approve it, I guess, based on the comments, or hear comments and either approve or not approve it at the next meeting. So we'd have to get started on that rule. The reset or reinitialization of the actuarial method, we could actually approve that or not approve it at at the August, for example, meeting. That's the one that we really don't. It's not one that I don't believe requires public comment well, it'll be on our agenda. So we can receive public comment, but I don't think we have to publish it or anything of that nature. It would be comparable to when Mark comes and says, well, we should be using 7.5% instead of 7.75%, or any of the other assumptions, a new mortality table, whatever else Mark does as it relates to the actual evaluation. So that one we'd have, in order for this structure to work, we as a board should probably discuss it now, but I'm just saying we don't need to adopt or approve anything per se now. We just have to have it would be good to know that the board has a comfort level with that reinitialization of the actuarial method. On the other side, though, the rule does need to be, I think, approved now, so that's one we need to really discuss. Yes?
One quick question. In the example you pointed out of a department who's at the minimum 36, and we're going to apply the 15% rate there, the $5 increase. Would that be for 1 year going forward or until the next?
Well, it's anticipated that it would be for 30 years, but it would be 2 years at a time. It would be reviewed every 2 years upon the completion of the actuarial evaluation.
Okay. So if that increase were to be put out there, it would be for a 2-year period.
Right. But they should think in terms of the long term.
Sure. Sure.
But again, every actuarial evaluation, we would get an additional piece of information from Mark, and it would be how much or what percentage within the 0 to 15% range is necessary for him to certify that we have an adequate funding arrangement. And we expect that that's going to fluctuate. We'd like it to fluctuate eventually to 0 and just stay there. But again, it would be something that would be reevaluated every 2 years, and it would become part of Mark's report to us. And then we as a board would then need to make an action, have an action to adopt the 7.7, the 10, the 15, the 2%. I mean, it could actually vary to all sorts of even just very small numbers. It could be 1%, but that would be the approach.
And all in the name of helping to keep the fund actuarially sound.
Yes, the funding arrangement.
Without changing benefits or retirement ages.
Right. And I certainly agree that changing benefits, reducing benefits is always, we try to make that our last option. It just doesn't go over well.
So I guess right now I'd like to know what questions or thoughts and how you feel about the sorts of things we're discussing and proposing here. And Michelle looks like she wants to say something.
In my mind, this Part 2 portion to the contribution over time would go down, since we most often make more than the assumed rate of return. And as we bring additional departments into the system who are not bringing losses with them, how do you feel about that?
I agree that increasing the number of active participants or your dollars of contribution are increasing would be a positive. It's a little bit uncertain to count on investment gains because the 7.75 is a long-term average annual rate of return, and if we thought that it was going to consistently beat that, we should be assuming something higher. So that's sort of although Don likes to say that assumption maybe is got a little bit of conservatism in it, and maybe it does. Who knows? We don't know the future. It's sort of looking backward and looking forward. We consider capital market assumptions of economists, investment consultants, and
but generally
look at history.
Speaking, given that we've had an inadequate contribution arrangement, and it's not been actuarially sound, and even though the fund has been making a lot of money, it hasn't been able to. It doesn't show that on paper because the system was, underwater. But once it does have an adequate contribution arrangement, I'm just thinking, generally speaking, it looks like to me over time, if we did set the fee, it would probably go down.
Well, one thing working in favor is, let's say we're projecting 8/31/2016. We had the 7.7%. Let's say that was our Part 2 contribution, and that was projected to be for 30 years. Well, 8/31/2016, if everything followed our assumptions, we'd still be able to lower it because it'd be like refinancing a mortgage. We'd have a new 30-year period. We'd get 2 years more. So that you're right, there is something there that is going to be in favor of, over time, reducing it. Now, I did want to, I shared some of my observations with the committee, but when you do squeeze out all the gains, then if the market has a substandard or below 7 3/4 in 15 or 16, then we've lost some ground, and we might have to increase the Part 2 contributions. Another thing, if the data cleanup produces more service than we had been recognizing in the past, and we have an actuarial loss, that's another thing that could cause the Part 2 contribution to be higher than is shown in these exhibits. And then there's one other thing. From time to time we will do experience studies, and we'll change the actual assumptions as to rates of retirement and termination rates. And so anytime you make changes, there's going to be some ups or downs in the actuarial liability. And one of the things that's come out this year has been it's an exposure draft at this point of a new mortality table for pension plans, for uninsured pension plans, that they discovered that mortality improvement has been greater than had been projected based on the prior study in 2000. There was a projection scale in that table, and they found that mortality improvement has been more than had been projected. And so at some point we may change the mortality assumption, and it's likely we'll be assuming somewhat lower rates of death. That would be something that would cause an increase in the normal cost, increase in the liabilities.
Maybe we can do that next time.
We don't need to do that right away. Mortality is not something that changes dramatically over a short period of time. It's a real gradual thing. But that just to give you a heads up that we do have to, and we review the assumptions every 2 years. But in the August board meeting, we give you a report where we've looked at the actual assumptions, and if any of them need changing, we recommend it in that letter. And that's where we would address the actuarial value of assets methodology, that letter. Okay.
I kind of want to echo what Dan said. When we started talking about this, I'm one of the members of the, I'm taking the benefit. I'll be receiving a benefit, and when we took this job or this position, we knew that we're the ones that have to make the tough decisions, and none of us want to decrease the benefits whatsoever, but I don't think any of us also want to, add any other burdens. But there comes a time that if we actually want to have a system, and a system that is going to be there for the members and the firefighters, and that's who we're supposed to be representing, you've got to be able to make that decision, and that tough decision. And as much as I don't like it, I think the best thing to do is when we entertain the new rule, is to pass that rule and try to keep the benefits intact as long as we can.
The purpose for the rule is to have a mechanism in place to use it if we need it. We don't have to.
Correct. That's a good point too, Ron. I mean, if we get there and we just get too much pushback, well, then we start talking about the other benefit options or what have you.
And that was a question I was going to have. I mean, I'm sure the firefighters, the participants, are going to be happy that we're not messing with their benefits. My question is, what about the entities? What do we, I think first we need to be educating them that this is coming, but what if we start getting some resentment or some flack from it? Where do we go from there? We know that we learned from previous discussions, the law says once in, you're always in. But so I guess that's my question. How have we got a plan in place on how we're going to educate them and explain why we're doing it? I think that's the main thing, is educate them that this is our two choices, though.
I think Michelle has in essence, a plan. Go ahead.
Well, I've drafted a letter that, should the board approve to post this rule, would go out to the departments, and it would explain to them what we're proposing and why we're proposing it, and give them a copy of that rule, and invite them to submit their comments or to address the board at the June meeting prior to adopting that rule. I think that's, a good first step. And in your red packet, I went ahead and took the liberty of calculating what each of our departments would owe if it was at the max of 15%. So, we can show that to them, and just to lay it all out there. There are some departments that pay more than 36, and those departments may decide to lower their contribution as a result of this increase. There will be a certain leveling that occurs if the board passes this. But at the end of the day, when that dust clears, you will have a permanent mechanism to keep the system sound, barring any crazy investment things that might happen. But, that would be a local decision to reduce their firefighters' contributions.
And I think that's a good point. We're putting we're giving them the authority. If they elect that they can't pay for it, and if they're not at the 36 and they want to reduce it, then they're basically putting that on themselves. We're giving them that authority anyway. We're not taking it away from them.
And that could be, again, if we get a tremendous or a pretty heavy pushback, we could begin to entertain whether the maximum might be reduced from 36 to 32. So that the one, or something of that order,
sure.
So that the ones that weren't even doing extra currently, so I mean, those are the kinds of things we could discuss. I wouldn't do that yet, because frankly, I think, particularly looking at these numbers, expenses are going up in many different ways, and that, of course, puts a burden on the departments. Having said that, we're like the one expense that really hasn't been going up, unless they choose to have it go up. And again,
in the preamble to this rule, it's not a final draft. Jim had some minor changes that he wanted to make to it, but we mention a study that was done by FEMA, and it says that the savings to communities every year by volunteer firefighters is around $45,000 a year. And, that's a savings that community is realizing.
Per firefighter.
Per firefighter.
Per firefighter.
Per firefighter.
Yeah.
And,
Huge number.
that,
Anything that we, excuse me, this has been a concern of mine all along. Each year that we go to our city budget workshops with mayors and council to secure the funding for another budget year for this pension plan, they lock in that number. They know that whatever that contribution rate is what it's going to be, or we're asking them for more. They approve that on an annual basis. If we go back to them with this Part 2 contribution we're talking about, and that could change that number, we've got to get ahead of that curve of explaining to them why this might happen, why we might require that contribution amount to go up slightly every year or two or every couple of years as we adjust our plan, and referring to numbers like you just were saying as a leader. We're the volunteer fire service is saving this city X number of dollars. All we're asking is potentially to keep our pension solvent, coming back and slightly adjusting that number. That's something that a council is going to have to vote on in budget hearings or budget meetings each and every year, and they got to know why it might change every couple of years.
Yes,
that's my concern.
Steve and I were just chatting a little bit also about another reason why we ought to put this vehicle into our rules. In most other circumstances, the sponsoring entities do have contributions that go up and down. I mean, all corporate plans, most public plans, if the requirement is for it to be more, it's more. In our plan, because of its structure, if the contributions as it now stands get to be more, the benefit gets to be more, and like I said, it doesn't get you anywhere. It just kind of, it maybe gets you a little bit sometimes, but it just doesn't do much for you. And so this linkage between contributions and benefits is a very unique, special circumstance that we have, and our inability at this point to fluctuate the contribution based on the financial health of the plan is a very unusual situation, and that's in effect why we think it'd be good to, at least within limits, and that's where we got the 15 from, within very reasonable limits. We just felt that we needed that flexibility, which is a flexibility and a burden in some cases and a blessing in others that virtually every other pension plan in America has, and we don't have it. And so now we want it, at least within reasonable, parameters.
So going forward, that would mean that the rule would set that in motion, right? It would be going forward to where now the contribution, if it went up, then automatically the benefit's going to go up. In other words, the rule's going to change it to where if the contribution goes up, then the benefit does not go up.
No, not really. There will become two parts to the contribution. One will be the Part 1 and one will be the Part 2. The Part 1 is still linked to the benefit. And if a department says, I'm going to change it from 36 to 50, my Part 1, benefit goes up. 36 goes to 50. However, this Part 2 one, which is based on from 0 to 15% of the Part 1 contribution, that one, which we will set either at our December or early, the following year board meeting, that one will not influence benefits. That one is simply a cost increase, and some years a reduction. I'm sure it'll fluctuate both ways over time. That is what we need to do in order to support a financially viable plan for the firefighters. So that's why I'm saying it's sort of, because they still will have that Part 1 that they can move up and down and make their benefits go up and down. I keep saying up and down. No department that I'm aware of has ever moved it down. And I'm not entirely sure whether our rules Our rules are silent on that matter of moving it down. I think we probably have the ability to authorize it, but our rules, I believe, at this point are silent about the ability of a department to reduce down to, from 50 to 40 or what have you. We have a minimum. You have to do at least 36. In any event, that is something to discuss later as well, potentially, if we get much pushback or much concern. Does that clarify that? Okay.
Yes. Michelle, going back to something that Mark said, and regarding the data, finding that maybe it wasn't correct in the years of service or so forth, do you think that by August that pretty much will be set, whether it's good data or not?
Yes, and I think the reason the question came up is that in the past, the agency hasn't always diligently collected annual reports from every department. And that annual report is the mechanism that service time gets put into the pension system. So if we don't get an annual report for Bobby Joe, we don't record Bobby Joe's service time in our system, so that when Mark does the annual valuation, he's not going to pick up that service time. And so now, as we're doing the annual reports, and what we found when we gathered some this time is we got several years at once from a department. I don't think it's going to be material, but it's hard to say because we have all of the ones that we received for 2013, except for a few that we granted extensions to that are still outstanding. So I think the data is pretty much there now for that. But as we go along in everyday situations, when a department calls in, sometimes Jessica's group discovers that they haven't recorded service time. It may be an active calling in and saying, hey, I got my statement and I'm supposed to have 12 years and it shows 2 years, and they research it and they figure out that was the issue. So I think that's probably the biggest issue in the data cleanup that could have an impact on the actuarial valuation. We did do a death audit on the entire system, and that had not been done before. We did it on all the actives, all the vested, all the terminated, all the non-vested terminated, the whole ball of wax, and we got 500 folks that were deceased back in that report. Fortunately, they were all terminated and not vested, which means it wouldn't have an impact on the actuarial valuation. That's just cleanup that has to be done. So, again, I think the annual report issue was the biggest change to the data, and I think we'll find out pretty soon what the impact of that's going to be.
Very good.
Frank, do you have any thoughts or comments? Again, right, so I guess I think it's going to go to the Rules Committee is where we're going to actually vote on the actual language. So no more discussion on that. The other thing I want to do, kind of survey the board on, though, is this notion of the reinitialization. I want to make sure that everyone is at least reasonably comfortable with that notion of a step we might take in August. Does anyone have any? It's not a vote, again. It's probably that's not even clear we'd vote on it when we do it, but I just want to make sure everyone in there, is feeling okay about that concept. So I don't know if I can have just a quick go around the table.
Yeah, I'm good.
Yep. Good, shaking heads, yes? Good.
Yeah, I'm good.
Okay.
When you reinitialize in August, what if there are losses that first year? I mean, I know there's the smoothing effect, but when you're just starting up, I don't know how that works, Mark.
It just falls.
Well, if there were losses in the
year
fiscal
1 and 2.
Fiscal year, okay.
Following September 1 of 2014.
Let's say there were losses in both 2015 and 2016. Then in the 2016 valuation, we would start with the market value at that point in time, and we would add back in 60% of the loss in the first year, and we'd add back in 80% of the loss in the second year. So we'd be using an actual value of assets greater than the market value. We would recognize part of the losses, but we would defer the rest. And the rationale behind that methodology is to give time for gains and losses to partially offset each other. So hopefully in the 2018 valuation, there would have been some gains that would partially offset the losses in 15 and 16.
So you're not penalized, in effect, by reinitializing?
Well, you're not penalized. You're recognizing all the gains that would have happened up to August 31, 2014. So you don't have any gains in reserve to offset losses right away.
Mm-hmm.
A lot of these losses would be rolling off. A lot of the losses we're smoothing would be rolling off because that was from 2008. Is that correct? Most of them that we were, and the gains also since that time.
Yes. Yeah, that's.
Because 2008 was kind of an anomaly that got us in this situation.
Yeah, that'll have rolling off by the 2014 valuation in any event. We are anticipating, again, you don't know, the year's not over, but we're anticipating that it's simply going to be all gains. Every last period that's going to be smoothed when we come to the 2014 period, the 2014 valuation. Every period is simply going to be gains that we aren't reflecting unless we reinitialize. So
that's right.
Okay, well, I think we've done what we've needed to do on that topic. Do you have the PECOS document?
It's in the green folder.
The green folder? Now, here's where we have a little bit of a topic that you might have wanted to have the Actuarial and Audit Committee deal with on its own. I haven't looked at it yet, you see. But we have a merger arrangement to bring PECOS into our plan, and it's going to be an actual merger, I believe, of another plan. This will be, I believe, did we use the 5%?
We did use 5%, yes.
This will be the first of the mergers where we implemented that suggestion from last time that retirees and term vesteds, if they want to bring them into our plan, that we use something that's a little more comparable to a market rate to determine the liability, the amount of assets they have to give us to pay for their retiree. I felt we were being a little too generous by using our 7 3/4 interest rate and so on and so forth, when the insurance industry, for that very same retiree, would probably be using 3%. And we didn't need to go all the way down to 3%, but I felt we ought to use something that was a little more in line with the shorter duration of retiree obligations and the so in any event, we're using, for this calculation, we were calculating the amount of money they had to give us for their retirees and term vesteds using a 5% interest rate, not 7 3/4, and we had discussed that already. I think we also have a rule. Do we have a rule that's going to authorize, that's going to make that an official rule? Didn't we have a rule change too for that? No, we don't have one for
yes.
that.
Yes, there's 306.2.
I thought that one didn't require a rule change.
It doesn't have the 5% in it, but it does mention that the board has the
it allows
authority
you to do it.
Yeah,
set the
yes,
rate.
yes. That was what it is. That's right. So
There's a copy for everyone in that clip, but we wanted to take them up afterwards because they are somewhat confidential. That's why they're not part of the regular board packet. So there's a...
So pass it out.
While you're passing those out, I'll just describe there are 2 documents. One is a prior service cost study for the 36 active volunteers. They can buy back up to 10 years of service according to the current board rules. This is a program that the staff uses anytime a department expresses interest in joining. If they have an interest in buying credit for prior service, this is the program that does it. And this program produces output that shows the monthly benefit that would be purchased and then shows a projection if they've worked 5 more years and had 15 years at retirement, and then it has a projection if they continued as a volunteer to age 55. So those are the confidential things, because there's a line for each of those 36 active volunteers. The present value or the cost of the prior service for those 36 was determined to be $76,487 in that study. And that study is based on the long-term rate of return of 7.75%, because these are actives. These are not pensioners. The second document is the present value future benefits for 25 pensioners that are in the TELFRA PECOS retirement fund for the Pecos Volunteer Fire Department. The 17 retirees, 7 surviving spouses, and 1 deferred vested firefighter. We had information on their benefit amounts, their dates of birth, spouse date of birth, the monthly benefit, and we calculated the present value of those benefits, assuming that they merged that plan into the system, and these monthly benefits would be paid from the system beginning the end of April. In that case, the present value future benefits is $206,027. So those are the two key numbers, the $76,000 and the $206,000. Those are the two key present value numbers.
Wanted to add that Jessica spoke with the folks at Pecos yesterday, and they are prepared for these kinds of numbers, and they have the funds available, so they're ready to execute his contract as soon as we send it over.
So they wouldn't have a unfunded prior service at all? They would simply fund the entire amount initially, and off we'd go?
I think
Okay.
that's what we're talking about.
I was never given any information about their assets.
Yeah,
So
they have the money available to pay it in full.
I thought it said full payments here. One period, 10 years.
I think it was an option, and we give them a study to give them.
The option that's shown in that prior service cost study is just the traditional, if they chose to pay it over 10 years, that would be the quarterly payment over 10 years. This really is not a merger document itself. It's just the cost of the prior service liability.
It's my understanding that for whatever reason, they had some unspent money set aside for this that have just kind of been sitting there and waiting.
Or is it the plan money from their original plan? Might be that as well.
Both, maybe it's both.
Both, yeah. So I guess what you need from us is, of course, any conversation or discussion of the issue, but also we need to approve you moving ahead to finalize a contract with Pecos. Is that the essence of the action that you'd like? So initially, though, I'd like to know if there's any conversation or questions or what have you.
So you haven't actually looked at this yet as a committee, right?
That is correct. The committee is seeing it brand new, just like y'all.
So we probably ought to take some time and look at it and review it and see what we think it's gonna do as far as increasing our liabilities even more, huh?
Well, it's not going to increase our unfunded liabilities. Oddly enough, it's actually, well, I don't know where the entry age normal number is going to come out for the actives, but for the retirees and term vesteds, we're going to, charge them based on a little bit closer to the market rate, and then when the actual valuation goes on, we'll actually have more money than liability for the retirees and term vesteds. Not a lot, but there'll be a little there. And then the actives will probably, I don't know. There's a cost liability for the accrued benefits that Mark calculates for these special studies, but then when we do the actual actuarial evaluation, there's kind of a spreading of the ultimate benefit over careers, and it's very often that the actuarial liability, the one from the valuation, is a little bit larger, or could be. And Mark would know more for this particular group whether it's going to be larger or smaller. Quite commonly, it's a little bit larger. So long and short is it'll probably have a very minimal effect, one way or another, on the unfunded liability.
Right.
And that would be the way we would anticipate it. So, Mark, would you agree with that?
Well, I would agree, and just reiterate what I told Michelle. When you get an increase in the number of participants, the normal cost is less than the Part 1 contribution. So you have some additional contributions coming in that are available to amortize the unfunded liability. To the extent there's no unfunded liability associated with PECOS because it's fully funded by the transfer of assets, it is a positive to the system.
Right. But again, we don't know for the actives exactly how that actuarial liability is going to compare to the measured liability here, though, right?
That's true. Yeah.
We know how it's going to work out for the retirees and term vesteds.
Right.
It's going to be a little bit of a surplus there, but
right.
The other one,
yeah, it can be
a little harder.
Yeah.
But the long and short is that it should not negatively affect our plan, particularly given the rule we put in effect a while back. We should be fine that way.
So, Don, do I understand that or Mark, they're basically going to turn over $280,000, correct? And then that's going to pay for those retirees and what have you. So other than that, then it's just an average department entering the system, and I guess they're entering at 36 is what they're talking about entering. So it's just like any other department that would be entering.
Yeah, it's right. Really, this one is, as best I can tell, is a pretty clean situation, particularly if they're going to fund their liability fully at day one.
Right.
Do what?
Also the 5%.
We actually felt that, and correct me if I'm wrong, Mark and Jim, the new rule that authorizes us to set a rate for the term vesteds and retirees, we're putting that new rule in, but we felt that the general rule that we had before would actually let us do it. We just wanted to make it real clear in our rules. So that was a question Steve had asked, do we need to pass the new rule before we can authorize PECOS? And I think the answer is no. We were just making the rules very clear and clean that we're going to set a separate rate for retirees and term vesteds. But the old rule that simply said you're going to do it on an actuarially sound basis or some language to that effect, we felt granted us authority anyway. And so I'm kind of responding to, I'm sorry, I started talking, responding to Steve's question without telling you what the question had been, but, part of it, but...
That was my understanding, that we were putting it in a rule so that it would be clear since you had charged something else in the past.
Right. So again, we can...
There's a copy of it in your red folder if you want to read it.
Yeah, there's of that aspect, yeah. I mean, it wouldn't hurt to pass it before we authorize PECOS's merger, as long as we're...
Well, the red folder is actually the rule that's relating to the contribution increase. The one you're looking for is in the board packet, and it is on page 128.
That's the cover.
Yeah, the primary new language is subsection C.
This rule, Jim Krause from the AG's office, the earliest date that this rule could be effective is 20 days after your next meeting. So I don't, unless there's a really big concern, I don't think you'd want to wait on PECOS. I think you're fine.
Thank you, Jim. So we'll just So we'll look at this when we get to Ron's. So Frank, if you'd prefer, I think it'd be fine if you'd rather have the Actuarial and Audit Committee spend a little more time looking at this. I think we're fine here, personally. But if you'd rather have us spend more time looking at it, we could have the full board simply approve that Michelle moves forward after having one last conversation with the Actuarial and Audit Committee or something of that nature. If you'd like to do it that way, or we can just approve Michelle to move forward. Because I'm pretty comfortable with this one.
I'm good with it. I looked at all the, doesn't seem like they're buying back a whole bunch of time. I mean, they're buying a little bit of time, but I don't. I'm all right.
Okay. So
I looked at the numbers.
I guess I need a, if I could get a motion to authorize Michelle to move forward with Pecos, our executive director, to move forward with the merger.
Michelle, you mentioned other rates were used in the past. What other rates?
I think we've used the assumed rate of return in the past. It's 720.
So is this, are we just going to generally use 5% going forward, or is it a target? Or?
It's going to be 5% until the board decides that it shouldn't be 5%. Now, the 5%, again, is only used for retirees and term vesteds. That an entity or a department that had an existing plan, when they merge it in, some departments just come brand new and they say, okay, we haven't had a plan before, we just want to join. None of this applies to them. They simply start up, and the 7 3/4 is used for any purchase buybacks that they do. But for the plans that have these old legacy liabilities from whenever, we just wanted to use, or have the ability and use, something that was a little bit more market-related as opposed to simply our actual valuation assumption-related. It was that kind of a decision process. So do I have a motion?
So,
And Steve's moved second.
Second.
Gracie seconds. Any further discussion? We could, all in favor?
Aye.
Opposed? Passes. And I believe that concludes the actuarial and audit matters. So if I could turn it back over to Frank. And
thank you, Don. That was quick.
I knew you'd like that. I guarantee you, if you look at the volume of material related to the other options, you'd be doubly pleased, because that would not have been quick.
Well, we appreciate the committee's hard work, and I know y'all spent almost a whole day reviewing the different options, so we appreciate y'all looking at the entire spectrum and and come up with a recommendation. I will move on now to item 9, Evaluations and Rules Committee. Committee Chair Ron Larson.
Okay, well, very first item is the one we were just talking about. If you want to turn back to that page in the book. Basically, I think we beat it to death. All we need to do is vote on it. Right, so.
I'll make the motion that we accept the proposed rule 306.2, the merger of existing, is that, no?
Yes,
Is that
merger of existing pension plan and
plans in the
pension
pension
system.
system?
Got a motion, on a second.
Can you add contingent on review by the Attorney General's office?
By the Attorney General, contingent on review by the AG's office.
Now, do we have a second?
I'll second that.
Got a motion and a second. Does everybody vote?
Aye.
Aye. All opposed? Motion carries. Okay, this other one, we've also beat to death. This is 310.6. This is the one that's in your red. No.
This is the one that, it's in the red folder.
Right. But this is what we were also just talking about. This is basically giving us a mechanism to do this, to be able to do that part too. You may use it, you may not use it, but want the mechanism in place. So is there a motion on 10.6? You need something, Michelle?
I think Frank said something.
Well, Before we approve this, Ron, would it be okay for us to get, we've got a department here, maybe we can get some feedback from
Did you want to talk on
some
it?
of our members?
Sure.
Chief, if
Always will. Did he sign in?
come on up, Chief.
And again, I guess certainly on the, what we're really approving is for it to be published, and the real approval will come at the next meeting.
Right.
Yeah, okay.
That's
Okay.
lots of opportunity to come.
Thank you, Mr. Chairman. My name is Robert Heminger with the Pasadena Fire Department Local Board Chair. Yes, sir, in reference to the proposed Rule 310.6, I understand that being considered today is an option to publish that rule for public comment, and no final action will be taken until after that public comment period and the next board meeting. I did have an opportunity to talk to the executive director briefly before this meeting, so got a little bit of information about how the committee had worked to look to maintain the current level of benefits. And personally, I know that the Pasadena Fire Department definitely appreciates those efforts to try to maintain those benefits. That's vitally important to us to offer to the members. And any kind of a reduction is just really tough for us to buy into. Still have some reservations about adding an additional fee. I know that's a bad word. Most bad words start with F. Fee is another one. So that's. But that is that. I think that is the perception of this is a fee that's being tacked on to the entities. One thing that came to mind as I jotted down a note that I am curious about. It was mentioned earlier and has been historically mentioned that once you're in, you're in. There's no real mechanism for a department to get out. But I'm curious about all of the existing contracts that the agency has with all of the participating departments that don't say anything about a Part 2 fee, or contribution rather, I'm sorry. And could that be considered a substantive change to that contract that would allow them to decide they want to go to the VFIS LOSAP program or some other mechanism that's in place that perhaps they have to at that point consider? Do I want to do this, or do I want to look for something else? So I'm not looking for an answer for that. It's just something that I think might be considered by some of the departments. In reference to something that is there for the sole purpose of maintaining benefits, offsetting unfunded liability, I think I would be in favor of that. I would like to see some safeguards put in so that in future years that fee wasn't used for administrative costs or additional expenses that future executive directors or future boards just decided, well, we want to start doing this as well, and we'll just increase the Part 2 contribution to cover this. I'd like to see it narrowly defined to specifically offset that unfunded liability. And then I guess it somewhat relates to this. I'll hold most of my public comments for the official section, but dealing specifically with this item, one of the things that my counterpart and I had discussed is the potential for limiting the exposure to the 6.2% interest. It seems like it was suggested at the last meeting that that's kind of where the problem comes in, and is the fund is pretty solid for that first 15 years, but when you start adding in that 6.2% interest on service past year 15, as that extends out, you start looking, you start having to look for actuarial gains to offset that liability, and so perhaps there would be a consideration for capping that at 10 or 15 years, or some mechanism in there, and perhaps even a mechanism that would support active retirement. I know some of the participating departments allow members to continue active service past their age 55 retirement age. They start drawing their pension, but they continue active service with that local department. And perhaps that might be a limiting factor or a contributing factor to why members are continuing on and gaining those 6.2%, because if they start drawing their money in their particular department, they would have to truly retire and no longer be active. And I think the nature of volunteer firefighters, they want to continue to serve as long as they can, and the money isn't really what's you know, the consideration. It's being able to serve the community. So perhaps if something were specifically in there to support an active retiree, then there might be another option. Just a couple of thoughts that I had on the proposed rule. Thank you.
Thank you, Chief.
Okay. Can we have a motion on 310.6?
I move that we adopt it, or publish it.
Publish it. Got a motion from Don. Do we have a second?
Subject to the AG's, because he's working, he has a few minor changes on the preamble.
Just the preamble, yeah. Okay, we've got a motion and a second by Dan. All in favor?
Aye.
All opposed? Motion carries. What else do we have?
Item E.
Government code. I don't know anything about this, Michelle.
We're gonna do that one tomorrow.
Okay. Okay.
How about?
Okay, and then the last one, E. We talked about this at the meeting in December. All this is just semantics. We're changing the name from chairperson or commissioner to executive director. It's just semantics. It has to be published, so can I have a motion to change the name? Got a motion from, yes, ma'am.
If we can just make sure you say a motion to adopt.
Okay, motion to adopt.
It'll be effective 20 days from now.
Yeah. Motion to adopt the name change. We got a motion from Dan. Do we have a second?
Second.
Got a second from Steve. All in favor?
Aye.
All opposed? Motion carries. And I guess that's it until tomorrow on the one item.
Yes.
By the way, I recollected that I had one other item, that just a bit of information. The audit, this will be the last audit that the state performs for us for free, for a while anyway. They have indicated that they are going to not be performing our audit this next coming time, and we're going to have to find outside support for it. I guess it just has gotten to be a little bit more work than they want to do for us for free.
When they visited with me, they said it was primarily because of implementation of GASB 67 and 68 and the testing that would be required on their part.
That was one part of the
Because I didn't want to
more
take
work.
it personal that they were leaving.
Yeah,
So
that was-
it wasn't personal.
But, again, having said that, we're going to have to pull together a contract and find an auditor and we'll probably have a couple come in that we can interview, and that will be taking place sooner rather than later, the next, how do we want to handle that? Do you want the Actuarial and Audit Committee to work down to the finalists? And
we probably,
I wonder if we're going to have to do an RFP?
RFP, I believe so.
We probably need to get moving on that because, again, our fiscal year, it's not that far away anymore. I mean, and the auditors are going to need to look at past audits and try to get themselves accustomed to it, I believe, right? And so
I have a question on that. When we made a change in line item budget a little while ago, we took $18,000 from professional fees and put it into supplies. Was that $18,000 in any part an offsetting of the
This will be a
audit that we had not been charged for recently? Wasn't it a $25,000?
yeah, we kept up 20 or 25,000 in the budget, and then they don't charge us, so we get it back, and that's probably.
But now we'll have to pay that out. I don't know if it'll be a similar amount.
We have a separate line item for that.
Yeah.
And it'll be next fiscal year?
Yeah, it'll go in the next budget, but it'll be a similar amount.
It might be more.
I think it'll probably be
And
more.
that was a kind of an arbitrary figure that, since they were going to charge us nothing anyway, we didn't worry too much about exactly how much we put in there. So I think we do need to go, and I suppose it might be
I
useful.
need to get it on your next committee agenda to go.
Do we need the board to take an action in order for us to, actually, the executive director can submit the RFP and just move forward, getting things rounded up for us, correct? Okay, so just so you know, that's in the works now, too.
Thanks, Don.
Do we have any idea what it's going to cost for a product?
More.
Rather
It's probably going to be more than what we have budgeted.
It probably is.
Sure.
Yeah.
And we do need to get them in as soon as possible,
Yeah,
because
we just wait.
more than likely they'll want to get in before the end of the year and do some
We'll just
work
wait till tomorrow.
to get caught up with what they need and get on the schedule, because they'll have other audits that they do, so we want to make sure we can get it in.
Well, then we should be doing interviews in June now.
Yeah, the actuarial and audit committee, I'm sure, is going to have to meet in between meetings to review.
And how would you like us to handle this? Would you all like the actuarial and audit to work with Michelle to narrow it down to a couple and then bring a couple in, or do you want us to just narrow it down to the one we think is the one?
Well,
Or how would you like to do that?
you probably want to get 2 or 3 finalists from. Typically, that's how we've done it. You do your RFP, and then you narrow it down to 2 or 3 and
Right, we would do
bring
that.
those.
But then the question is, do you want our entire committee, excuse me, I don't mean the committee, do you want our entire board to interview or look at or talk to 2 or 3, or do you just want the actuarial and audit to narrow it down, have the 2 or 3 finalists come in, actuarial and audit selects one, and then we recommend them to the full board, or do you want the full board to be more involved in interviewing several?
You probably need to have at least 2 finalists for the board to listen to.
So you'd like us
to come make a presentation at our board meeting.
And that'd be fine. So 2 or 3, if they're close, we can get 2 or 3, and we'll have them come into the board to make their final presentation.
Yes, sir.
That sounds fine.
Well, we're pretty much at a stopping point where we figured we would be about 6:30 tonight, but the actuarial and audit committee went a little bit quicker. We've got all our presenters for our investment matters and things to schedule for tomorrow morning. So unless y'all are adamantly opposed to stopping right now, we'd like to recess until tomorrow morning at 9 o'clock. Okay, so we'll be in recess till 9 o'clock in the morning. Thank you.